There is a single number that every institutional trading desk, every serious technical analyst, and every quantitative fund manager in the world is watching right now: $72,604. Bitcoin is approximately $100 below that line as of this morning. That is not a coincidence. That is not noise. That is the most consequential technical position Bitcoin has been in during this entire cycle. And the data unfolding around it right now deserves a clear, honest, and thorough examination. My name is Daniel. This is the Mystery Market Vault. And in the next 18 minutes, I'm going to walk you through exactly what the institutional data shows, what the on-chain signals are saying, and what the one macro event tomorrow morning at 8:30 a.m. Eastern could mean for where Bitcoin goes over the next 60 days. No hype, no panic, just the data and what it actually means. Let's get into it. Before we look at any flow data or on-chain signals, let's establish the map. Because the data only makes sense inside context. Bitcoin reached its cycle high for this bull run at approximately $93,000 in January 2026. Since that peak, Bitcoin has declined 22% year to date as of this morning. For anyone who entered at or near that level, that represents nearly a quarter of their position gone in under 2 months. I'm stating that plainly because glossing over drawdown numbers does investors a disservice. Understanding where you are in a cycle requires honesty about the magnitude of the move you are analyzing. The cycle low came on February 24th, when Bitcoin reached $62,900. From that low, Bitcoin has recovered approximately 15% over 9 trading days, bringing the current price to roughly $72,500. Now here's the context that matters most for everything we are about to discuss. The 200-day exponential moving average, one of the most widely referenced technical indicators across all asset classes, not just crypto, currently sits at $72,604. Bitcoin is trading approximately $100 below that line. This indicator matters because it is the line that separates, technically and structurally, a long-term uptrend from a long-term downtrend. Institutions use it. Quant funds use it. Pension fund allocators use it. When an asset is below this line, it is by conventional technical definition in bearish territory. Above it, the structural narrative changes. We are one daily candle close away from that inflection point, and whether that close happens, and when, is the lens through which all of the data we are about to discuss should be interpreted. Keep that number. We will return to it throughout this analysis. Let's talk about the money, specifically the 8 trading days of Bitcoin spot ETF flow data that has generated significant commentary and significant misinterpretation across financial media this week. Beginning March 2nd, US Bitcoin spot ETFs recorded their strongest single inflow day of the quarter. Net inflows on that Monday came in at $458 million. Every major fund posted positive inflows simultaneously, zero offsetting outflows across the board. When institutional allocation happens in that kind of coordinated pattern, without any dissent from major players, it carries a specific signal. This is not tactical positioning by 1 or 2 large funds. This is a broad re-entry across multiple institutions at the same time. That is a meaningful distinction. The following day, Tuesday, March 3rd, net inflows were $225 million. But the breakdown of that number contains information that the headline figure conceals. The dominant buyer, the largest single fund in the US Bitcoin ETF market, posted inflows of $322 million. However, one of its major competitors posted an outflow of $89.3 million on the same day. Read that carefully. 2 of the most significant institutional players in the Bitcoin ETF space made opposite directional bets on the same Tuesday morning. This is not a story of unanimous institutional confidence. This is a story of institutional disagreement. Wall Street is not monolithic on Bitcoin right now. There is a genuine debate among large allocators about whether this recovery is structurally valid, and that debate is visible in the daily flow data if you look past the net number. Wednesday, March 4th added another $155 million, bringing the 8-day total to approximately $1.7 billion in net inflows. That is the headline number. And it is genuinely significant at face value. But I want to explain something about how ETF creation mechanics actually work, because this is the piece being consistently left out of the conversation, and it changes how you should interpret those inflow figures. When a large institution creates new ETF shares, the entity responsible for sourcing the underlying asset does not always purchase the Bitcoin immediately. These entities can provide ETF share liquidity first, and then acquire the underlying Bitcoin later, sometimes hours later, sometimes a full trading day later. What this means practically is that a $458 million inflow day does not necessarily equal $458 million of immediate same-day spot Bitcoin buying pressure. The buying pressure arrives because every ETF share must eventually be backed by real Bitcoin, but it can be spread out, staggered, and delayed in ways that are not visible in the headline inflow number. This is not a reason to dismiss the ETF flow data. Total AUM across all US Bitcoin spot ETFs currently stands at $92.4 billion. and that figure represents real Bitcoin held on behalf of real institutional investors, that is committed capital, but it is a reason to interpret inflow numbers with precision rather than with enthusiasm. The buying is real. The timing of the full market impact is what requires more careful analysis. Now let me explain precisely what happened to the price over the last 24 hours, because the mechanism here is important and is frequently oversimplified. Following 6 consecutive weeks of Bitcoin declining from $93,000 to $62,900, a substantial crowd of derivative traders had positioned themselves short. They were betting on continued downside, and for weeks, the data justified that position. Then, at 2:10 a.m. Coordinated Universal Time, which is 9:10 p.m. Eastern the prior evening, Bitcoin broke above $71,000. What followed was a short squeeze cascade. Here is the mechanical sequence. Bitcoin breaking above a key resistance level triggered preset stop-loss orders held by short positions. Those stop-losses automatically issued buy orders to close out the short positions. Those buy orders pushed the price higher, which triggered additional stop-losses, which issued more buy orders, which pushed the price higher still. This is not a mysterious or unpredictable event. It is the mathematically inevitable result of an overcrowded trade encountering a price movement that invalidates the core thesis of that trade. In approximately 90 minutes, Bitcoin moved from just below $71,000 to above $73,000. $110 million in Bitcoin short positions were forcibly liquidated in that single session. Total liquidations across all crypto derivative positions in that 24-hour period, $471 million. $348 million of that, 74%, came from short positions. There is one additional dimension to this event that matters for how you interpret it. This move happened in the Asian trading session. That is not incidental. Asian session liquidity is structurally thinner than US session liquidity. There are fewer active participants, tighter order books, and it takes less capital to move prices when fewer counterparties are present. Sophisticated market participants understand this. They have understood it for decades across every asset class. In crypto, where retail participation is heavily weighted toward US time zones, it creates a consistent information asymmetry. The move happens, the cascade completes, and a large portion of the retail participant base wakes up to find they have already missed the entry. Understanding this dynamic does not necessarily change how you trade, but it changes how you evaluate the quality of a price move. A 15% recovery significantly driven by a short squeeze in thin Asian session liquidity is a different signal than a 15% recovery driven by broad, sustained spot buying across multiple sessions. Both can lead to the same destination, but they carry different risk profiles. The blockchain is a public record. Every wallet, every transaction, every deposit to an exchange is visible to anyone who knows where to look. And right now, the on-chain data is presenting two signals that are, in a meaningful sense, contradictory. And understanding both is essential to building an accurate picture of where this market actually is. The first signal. The exchange whale ratio has reached 0.64, the highest reading since 2015. This metric tracks the proportion of total Bitcoin exchange inflows that come from the 10 largest depositing wallets during any given period. A reading of 0.64 means that 64% of all Bitcoin currently being deposited to exchanges is coming from those 10 largest depositors. Exchanges are where you go when you want to sell. When the largest Bitcoin holders are depositing to exchanges at rates not seen in 11 years. The direct interpretation of that data is that large holders are preparing to sell into this recovery. That is supply entering the market. That is a potential ceiling on this rally. I am not going to soften that finding. It is what the data shows. The second signal. Simultaneously, on-chain data also shows that wallets holding between $100,000 and $1 million worth of Bitcoin have added approximately 13,460 Bitcoin to their holdings since February 19th. Held off exchange, not touching public order books. At current prices, that is approximately $975 million in Bitcoin quietly removed from available market supply. So here's what these two signals together are actually telling us. There is not one category of large Bitcoin holder acting in this market right now. There are at least two with different cost bases, different time horizons, and different strategies. One cohort is moving Bitcoin onto exchanges. Another cohort is accumulating off exchange at the lows. These are not the same wallets. They are not acting in coordination. And the on-chain data does not tell us which cohort's behavior will ultimately determine price direction from here. What it does tell us is that this market is not a simple, unified institutional accumulation story. It is a more complex picture in which different categories of large holders are actively working against each other. Now, one more on-chain data point, and this one speaks directly to where the structural ceiling on this rally may be. The 30-day moving average of realized profit has declined by 63% since early February, and as of this morning, only 57% of Bitcoin's entire circulating supply is currently held at a profit. Historical analysis shows that when this figure approaches 57%, it has been associated with early-stage bear market conditions. Not confirmed deep bear markets, but the early behavioral indicators of sustained downside risk. Here is the practical implication. There is a large cohort of Bitcoin holders, people who purchased between approximately November 2025 and January 2026, whose cost basis clusters around the $68,000 to $75,000 range. As Bitcoin trades back through that zone, many of those holders face a behavioral decision point: hold or take the exit they have been waiting for. Most investors, when presented with a return to break even after a painful drawdown, choose the exit. Not because they have made a calculated decision about Bitcoin's future, but because the emotional relief of not losing money is a powerful motivator. That behavior creates selling pressure at predictable price levels, whether or not any single institution intends it. On-chain analytics calls these levels distribution zones. They are real, and the current recovery is moving directly into one of the heaviest of this cycle. Everything we have discussed is happening inside a macro environment that deserves direct attention. The next Federal Reserve policy meeting is March 17th. Markets are currently pricing a 97.4% probability of no interest rate cut at that meeting. That is as close to a consensus view as financial markets ever produce about any future event. This matters for Bitcoin because the bull market from 2023 through 2025 was, in part, built on the expectation and subsequent reality of falling interest rates. When rates fall, yield-generating safe assets become less attractive. Capital searches for higher returns. Risk assets, including Bitcoin, benefit from that capital rotation. With rates on hold and the Federal Reserve signaling no urgency to cut, that tailwind is currently absent. The macro picture was further complicated this week by escalating geopolitical tensions in the Middle East. Oil prices spiked 7% in a single session. Elevated oil means elevated energy costs, which flows into broader inflation data, which reduces the Federal Reserve's room to cut rates. This is the standard macroeconomic transmission mechanism, and it is relevant to any risk asset with rate sensitivity. Against this backdrop, Bitcoin's behavior has been notable. It did not collapse on the geopolitical news. It held and then rallied. A growing segment of institutional analysis now argues that Bitcoin is increasingly functioning as a geopolitical hedge, a non-sovereign, 24/7 portable store of value that capital can move into during periods of geopolitical stress in ways that traditional assets cannot fully replicate operationally. Gold is currently trading near $5,400 per ounce, within 3% of its all-time high. Safe haven demand across the board is elevated. If gold becomes overcrowded, historical patterns suggest some portion of safe haven capital rotates toward higher beta alternatives. Bitcoin has historically captured a portion of that rotation. The timing and magnitude of that dynamic, if it occurs, is not predictable with precision, but the structural logic holds. Tomorrow morning, Friday, March 6th, at 8:30 a.m. Eastern Time, the U.S. Bureau of Labor Statistics releases the February non-farm payrolls report. This is the single highest impact macroeconomic data release of the week for all risk assets, including Bitcoin. The January NFP came in at 130,000 jobs, nearly double the consensus forecast of 70,000. An upside surprise of that magnitude tells the Federal Reserve that the labor market is robust, that employment does not need stimulus, and that the case for rate cuts remains weak. For February, the consensus forecast is between 155,000 and 165,000 jobs. That is already an elevated bar. The market has recalibrated upward following January. If February beats that forecast, the rate cut narrative weakens further. Risk assets face renewed headwinds. Bitcoin, which is currently attempting to reclaim the 200-day EMA, faces a more difficult technical environment. If February misses that forecast, the probability of a rate cut at the May or June Fed meeting increases. Risk appetite returns. Bitcoin gets a macro tailwind at exactly the moment it is testing a critical technical level. Tomorrow morning at 8:30 a.m. Eastern, before you make any significant portfolio decision, know where that number landed. I want to leave you with something more useful than a price prediction. I want to describe the cycle. Not as a conspiracy, but as a structural pattern that repeats because human behavior repeats. The first phase is quiet accumulation. This happens during maximum fear, when sentiment is in extreme territory, when the news cycle is negative, and when retail participation has declined. The on-chain data from February 19th onward, 13,460 Bitcoin quietly removed from available supply by large wallets, suggests this phase has been active. The second phase is gradual price recovery with persistent retail skepticism. This is the phase we are currently in. Bitcoin is up 15% from its cycle low, but sentiment remains near historical lows. Most retail participants are watching the recovery with suspicion rather than participating in it. This skepticism is rational given recent history, but it is also, structurally, what allows the recovery to continue with less resistance. The third phase is a catalyst event that forces rapid repricing. This week's short squeeze at $471 million in forced liquidations was one version of this. A technical breakout, a major news event, or a macro data release can all serve this function. The result is always the same, a fast, sharp move that the majority of retail participants miss the entry on. The fourth phase is where retail FOMO builds as price climbs higher. The entry point looks increasingly risky. Social media fills with confident retrospective analysis. Psychological pressure to participate increases. This is the phase where the difference between informed decision-making and reactive decision-making becomes most costly. The fifth phase is distribution. Large holders who accumulated at the cycle low need buyers at higher prices. This does not happen every cycle in exactly the same way, and it does not mean every retail buyer during a rally is buying into a trap. But the pattern is documented, it is consistent across multiple cycles, and it is worth understanding before you find yourself inside it. Understanding the cycle does not tell you where the top is. What it gives you is a framework for asking the right questions about your own positioning at any given moment. Am I acting on data, or am I acting on the emotional conditions that this phase of the cycle is designed to produce? Here's the practical framework. 3 variables. This is how I am personally reading the data in the coming days. Variable 1, the 200-day EMA daily close, $72,604. Not an intraday touch, a daily candle close, confirmed at market close, above that level. If Bitcoin closes above it on elevated volume, that is a legitimate structural signal. If Bitcoin reaches that level and gets rejected, the 68,000 and 65,000 levels come back into play as support tests. Variable 2, the NFP print tomorrow at 8:30 a.m. Eastern. Beat the consensus of 155 to 165,000 jobs. Hawkish Fed risk increases, technical level becomes harder to hold. Miss the consensus. Rate cut probability increases, macro backdrop supports continued recovery. This data point is binary in its market impact. Know where it lands before making portfolio decisions. Variable 3, ETF flow confirmation on the day of the EMA break. If Bitcoin closes above the 200-day EMA on a day when ETF net inflows are above $200 million, with broad participation across multiple funds and no significant offsetting outflows from major players, that is institutional confirmation of the move. That is the signal that distinguishes a short squeeze-driven technical breach from genuine, sustained institutional demand. All 3 variables aligning simultaneously would represent the strongest confluence signal available in the current data environment. Until that confluence exists, I am watching, I am preparing, and I am not chasing. The retail investor in this market faces a structural disadvantage, not because they lack intelligence, but because the speed of institutional moves, the complexity of derivative mechanics, and the timing of liquidity events are not designed with retail visibility in mind. The only durable response to that disadvantage is data literacy, understanding what the numbers actually measure, understanding the mechanics that produce price moves, understanding the cycle well enough to recognize which phase you are in before it ends. That is what this channel exists to do. I will be live Friday morning as the non-farm payrolls data hits at 8:30 a.m. Eastern with the Bitcoin chart and ETF flow data side by side in real time. If Bitcoin clears the 200-day EMA this week, it will be the most significant technical event of 2026 for this asset, and I will have that analysis up within the hour. If this breakdown gave you a more precise framework for thinking about what is happening in this market, subscribe and turn on notifications. I will see you Friday morning.